Welcome to the course of Financial Modeling. In this module, we will prepare a dynamic financial model for a venture in the hotel industry. Please go through the case study once. The first step is to prepare an assumption sheet in Excel wherein we will specify all the assumptions made by us for the model. The purpose of this exercise is to ensure that the MS Excel file has all the information incorporated and it does not require us to refer to the PDF again and again. This sheet will also help us in making the model dynamic. That is, if we change the values here, the model will incorporate the subsequent changes automatically. Vintage Hotels and DEL, the land providers, are evaluating a 1,000-room hotel project. The start date is linked to the commencement date of 1st November 2015. The end date of the construction period will be calculated through the E-date formula, which requires a start date and the number of months to be added to it. We have both these values in the previous columns. The number of days can be calculated from the difference of the start and end dates of construction. As the construction ends on 1st August 2017, interiors will begin on that very day. Again, we know the number of months it will take us to complete the task and thus we calculate the end date for interior decoration. The number of days again will be calculated in the same way as the construction days were. IT infrastructure period will also be ascertained in the same way as the other two. The total number of days in Capex timeline is 851. To determine the end of fiscal year, we will use a date formula. We will have to determine the three components of a date, that is year, month and day. Firstly, the year ending will be contingent on the month of the start date, because if the month of the start date is less than equal to 3, that is, if it is January, indexed as 1, February, indexed as 2, or March, indexed as 3, then the year would be the same as the start date's year. Otherwise, it will be the next year, that is the start date's year plus 1. Assumption sheet for the model. We will now prepare the following sheets here: income statement, cash flow statement, balance sheet, output sheet, and the working sheet. Now we select all the sheets except the assumption sheet because the formatting in all the sheets would be the same. We first select all worksheets by pressing Shift plus mouse click. Now when we enter data in the income statement sheet, it automatically gets incorporated in all the other worksheets as well. Now that we have the average room rent per day, we need to calculate the average occupancy rate also. These two are very important metrics in this industry. This is going to be calculated through one difficult formula, so please be patient. We use the if error formula here. What this formula does is it displays 0 in case any kind of error, and in case of any value it displays that only. What this formula does is it displays 0 in case of any kind of error, and in case of a value it displays the value only. We need to understand that the occupancy rate of every room type will change in different periods. The three periods we need to consider are: number 1, pre-commencement of operations, where the occupancy rate should be 0% for all. The second stage is from beginning of the operations till 31st March 2021, because during this stage the escalation in occupancy rate will be 3%. And finally, the third stage is where the date is greater than 31st March 2021, where the escalation rate will change to 5%. While writing the formula, we need to take care of all the three scenarios that can arise. We start with the if error formula as mentioned earlier, followed by the if formula. The first condition is that if the ending date lies between the commencement date of operations and 31st March 2021, then the occupancy rate in the first year shall be the same as mentioned in the assumption sheet, and the corresponding years till 31st March 2021, it should increase by 3%. This can be done by using the AND formula and the MAX formula, which was used in the average room rents calculation as well. If the date does not lie between these two dates, then it can either fall before the commencement date or after 31st March 2021. For this, we use the if formula again and tell Excel to give me 0% occupancy rate if the date lies before 1st March 2018. Otherwise, give me the prior year's occupancy rate increased by 5%. Now we will calculate the operating expenses. We will have these heads under operating expenses section. To avoid hassles, we will use the VLOOKUP formula and insert the respective percentages in the working sheet only. The expenses are simply calculated by multiplying the respective percentages of costs, which should be frozen, to the relevant expense heads as mentioned in the assumption sheet. For example, the expense for rooms is equal to 28% multiplied by the room revenues. The total operating expenses will be a sum of all the heads mentioned over here. The number of interior days is calculated exactly like the number of construction days. The total number of interior days will be 184 as can be seen in the third year only. The total interior cost will be calculated similarly as we did under construction. We will also add the electrical cost to this. Now we incorporate changes in working capital. We conduct these calculations in the working sheet. The first item considered here is stock. Since we know the stock cycle only, we need to do some backward calculation to ascertain the closing stock value each year. The stock days is linked from the assumption sheet. For closing stock calculation, we need purchases, which are a sum of spa and F&B expenses only. As in case of room expenses, we are assuming there is no stock purchase. Now we calculate the average stock. As we already know that the average stock is equal to credit purchases by stock turnover ratio, we can calculate it like this. Stock turnover ratio is 365, that is days in a year, divided by stock days. Therefore, average stock is equal to credit purchases divided by 365 divided by stock days. Average stock thus is equal to credit purchases into stock days divided by 365. The opening balance of stock in year 1 is 0. Since the average stock for any year is opening balance plus closing balance by 2, we can calculate the closing stock as 2 times average stock minus opening balance. Opening balance of the subsequent years will be the closing balance of the previous year only. Change in stock is nothing but current year closing balance minus previous year closing balance. We enter change in stock calculated in the cash flow statement. The change in stock here will be entered with a negative sign because an increase in stock implies an increase in current assets, which will lead to a decline in cash. EBITDA margin is calculated as EBITDA divided by sales. We will link the required fields from the financial sheet only. EBIT margin is calculated as EBIT upon sales. EBT margin is calculated as EBT upon sales. And similarly, the net profit margin is calculated as EAT upon sales. As mentioned earlier, these ratios are shown in percentage terms. Thus, to convert them into percentage format, press Alt plus H plus P. Return on investment ratios. These ratios are an indicator of the efficiency of the investments made in the company. Higher values indicate higher efficiency in general. The numerator of these ratios will consist of the returns on the investments, and the denominator will have those values of investments whose returns are calculated in the numerator. We will now have a graphical representation of the selected ratios. We copy the required ratios in a new working sheet. We first insert a column chart. Then we select the horizontal grid and delete them. Under the Design tab, go to Select Data. Remove all the series in the dialog box. Click on Add. Another dialog box opens. In series name, add the cell reference where the name of the ratio is given. In the series values, add the reference of the cells where the ratios are calculated. We do this for all the ratios we need to plot on the graph. After all the ratios have been inserted, click on Edit to enter the horizontal axis label, which will be nothing but years 1 to 5, and then click on OK. Just as we untick the profitability ratios, all the three ratios are displayed as NA, and in the graph all the three lines disappear. We can take only one ratio at a time to check out the trends of the different ratios and conduct our analysis in depth. The ratios will help us comment on the efficiency and profitability of the company. We need to conduct in-depth analysis of the ratios year on year to see how the company has performed in the period. For example, if we pick up the profitability ratios, we can conduct the analysis across EBITDA, EBIT, and net profit margins. The analysis helps us identify individual items which have had an impact on the performance of the company.